Hello everyone, thank you for tuning into Optiongig. How are you doing? The previous week has been a really volatile week, and I hope you all have been able to weather that storm and are still doing fine in your portfolios and also in your personal life. Lot of changes have happened in the psyche of people and US government in the past week. So we'll go through all that in today's weekly update. Also, I want to mention that I've changed a bit of format in what we cover in terms of trades. So instead of going into the top 3 profitable, top 3 losing, and top 3 new trades, I will pick just the one trade from each of those sections. But I will spend a lot more time in digging through or doing a particular trade analysis. This is to help those option traders who are just getting into option trading and want to understand, how do you manage the trades throughout the journey of trade. In any case, if you want to look at all the trades that I've done, those are anyway available on optiongig.com/trades. So you can at any time go and look at those trades. So I want to use this update to maybe dig a little deeper into one particular trade, pick up the learnings, what we can learn from that trade, and share all that with you. So lot of things to cover, and we'll do all that right after the music. So don't go anywhere. I'll be back in a few seconds. Hello everyone, welcome to Optiongig. This is your host Vivek, part-time option trader and full-time worker, husband and father. If you also want to generate consistent monthly income trading options while working in your regular day job, then join me in this journey. Alright, so let's now dive right into our weekly update. So today we're gonna cover the happenings from the week starting from 9th of March to 13th of March 2020. As always, let's first look at some major market moving news, and there was no dearth of it. News fairy has been pretty busy last week, as you will see right away. Top headlines in everybody's mind, not just in US but across the world, is coronavirus. If any country was little doubtful if they will be getting impacted by coronavirus or not, now know that they will be. It's not a question of if, but a question of when. World Health Organization also declared coronavirus as a pandemic, and America declares emergency situation. So the preparations are on war footing to deal with this coronavirus. And to deal with it, our federal government provided monetary stimulus. Both the Fed and the US government announced a lot of monetary measures to help out the businesses that are suffering because of coronavirus. Fed mentioned that they will inject $1.5 trillion of liquidity across different markets. Also, US government mentioned that there may be tax breaks coming up for consumers. There could be a moratorium on interest on student loans, and there could be some other measures also. Essentially, government wants to project that, hey, we are with you, small businesses, we are with you, we will help you to get through this crisis, which has now become a national emergency. I don't know how much of the monetary stimulus can solve the situation, because it is a health crisis, not a money crisis. Definitely having additional money will help those small businesses, but if people are not going out to eat, people are not going out to socialize, people are not going out to work, there is a little that monetary stimulus can do for them. but we'll see how it goes. But indeed, knowing that the government is behind the businesses, government is ready to tackle it, was really reassuring, and that showed up in the market. Uh, on Friday, after the government declared emergency, Dow was up almost 2,000 points. All right, third headline I want to talk about was circuit breakers were activated in stock market. Not once, not twice, but if I recall correctly, it was 3 times, because those market indices, they hit the threshold of 5% change, and then we had to halt trading for 15 minutes. I don't recall this happening in recent times. So if you are new to stock market, new to investing or trading, this might be a new experience wherein you want to place an order, but that's just not going through because the trading has been halted, because the circuit breakers were activated after the 5% change threshold was reached. And I think twice it happened because the market fell down and more than 5%, so the trading was halted. And I think once it happened because the broad market went up 5%, and then it was circuit breaker got activated on the upside move. But I don't recall in last at least a decade that within a week 3 times the circuit breaker had activated. So yeah, we are living in a strange times. This is not a usual time. Next headline I want to talk about is that the markets continued to stay very volatile. On 12th market, which is on Thursday, market had its worst day since the Black Monday of 1987. But the very next day, after government announced stimulus package, it recovered almost 2,000 points. Are we done with volatility? I don't think so. I think volatility is still here to stay for some more time. What we saw on Friday was a knee-jerk reaction on the government stimulus. But like I mentioned again, it is a health crisis. It is not a monetary crisis. So until we find a cure or we can reduce the speed at which this virus is spreading across, I think markets will continue to be volatile for some more time. So with all these market headlines, how did the indices do? No surprise that every major market index was in red. All the way from top market index ETFs, S&P, to even the safe havens. So in from this session onwards, I have also included 2 more tickers that we can track and talk about on weekly basis, and that is gold and TLT ETFs. So ETF on gold is GLD and the bond ETF is TLT. The reason I added these is many of the retail investors, they hold precious metals like gold or bonds in their portfolio because these are considered to be safe haven. These are considered to be moving opposite of market direction. So I thought it will be good for us to see week on week basis how are these performing. This week, irrespective of what's happening, whether they're safe haven or not, they were still down. So let's look into the broad market indices. S&P 500 SPY ETF was down 2.22%. Dow Jones ETF Diamonds, ticker symbol DIA, was down 4.05%. The tech sector ETF QQQ was down 0.34%. I think the tech sector did the best, or let me put it the other way around, it was the least worse ETF for the previous week. IWM, which is small caps, was down 12.27%. And gold, ETF based on gold, GLD, was down 10.69%. And the bonds, TLT ETF, which is based on 20 years and above treasury bonds, fell 16.34%. What gives? Gold and the bonds are supposed to move in opposite direction. That's what the conventional financial wisdom or the portfolio allocation states, that you should have stocks and golds and bonds because these are uncorrelated. But last week everything went down. So that brings us to the next section, or summary review. So what we did last, we actually closed 44 trades, out of which 35 were profitable, and we lost money on 9 of these trades. Now again, many of the profitable trades were the hedge trades that we had put in place, means which gain in value if the market goes down. So those became profitable because the market fell last week. So we made some money on those. Overall 80% winner for the last week, and we opened 78 new trades. I was aggressively managing the positions, so a lot of work indeed last week. All right, now let's move on to our next section, which is thought of the week. And the topic that I want to talk about is when the traditional asset allocation does not work. I think I briefly hinted when we were talking about how the major market indices did last week. So our traditional asset allocation, most of the financial planners will say, is keep money in stocks, keep some money in precious metals, maybe gold because that is the most traded precious metal, and keep money in bonds because gold and bonds are considered to be safe haven when things go wrong. When the proverbial S hits the fan, people move away from stocks and pile up into bonds and gold. But as we have seen a few minutes earlier, that wasn't the case last week. While the broad market indices on the stock, all ETFs on the stock closed down in red, gold and the bonds were even redder. They even fell more than what the S&P 500 or Dow Jones index fell. So clearly we noticed that the traditional asset allocation does not work in these difficult times. So as a retail investors, what options do we have? So if the traditional allocation not going to work, it doesn't help me when I need it the most, what can we do? Should we just resign ourselves and say, hey, this is how it will be and we can do nothing about it? I don't think so. You could still fight back in the market if you know how to trade options, because there are still things that really worked in last week. So if you know how to use options, you could have reduced some of the losses. You could have fought back a little bit more without adding additional capital. Some of the trades that were profitable for me last week were all the call trades. I had sold call options without adding any additional capital, and those made money when the market went down. So if you are trading only in stocks, ETFs, there's not much you can do when the S hits the fan. All you can do at that time is add more capital to reduce your cost basis. If you are using options, you do really have air finger quotes options to deal with. Now let's move on to our next topic, which is trade leaderboards. Like I mentioned during the initial introduction, I'm not gonna go through top 3 trades. You can look at all the trades on my website optiongig.com/trades. But in this weekly update, I will go through the top most trade from each section. So first one I want to talk about, the most profitable trade is the Our hedge trade, we have been putting hedge on our portfolio for a few months now. Just markets were so complacent in last few months that we started building our hedges just in case a doomsday scenario comes along, just in case market go volatile. So we had started building some of our hedges. So last week was when the doomsday became reality. So I had bought 10 contracts of VIX. We opened this trade on 9th of January and we bought each contract for 40 cents. Now I closed some of those contracts on 12th of March and on 13th of March, but at an average price of $7.52. So I bought these VIX options. VIX is a fear index, ticker VIX. I bought these VIX options at 40 cents and sold it back at $7.52, whopping almost 18 times return. It behaved exactly how a doomsday hedge should behave. We had put on this trade to protect us a little bit, to reduce the losses in case doomsday scenario arises, and that's what happened last week. So the hedge did its work and I closed it at a decent profit. Was it big enough to completely reverse the losses on the other tickers on the portfolio? No. Does it mean my portfolio is in green? No, absolutely not. My portfolio is down, but this has definitely helped us in reducing the loss. Okay. All right, the next one I want to talk about is we had a short put at Teladoc with a short strike at 115, and on 13th of March Teladoc had fell down to $114.21, so it was below our short strike. I decided to roll this out from March to April expiry and collect additional credit. But because I had to close down the March trade for rolling, I had to take a temporary loss on the March trade. But I got a lot more premium. I rolled this trade for net credit. So if market comes back to normal, let's say around April, we'll probably be able to exit this trade at a profit. Or if not, we have reduced our losses. So if you have been following this, you would have noticed this is very common way for me to manage my trades, which is, hey, let's give ourselves a little more time. If the market turns around and cooperates, we'll be able to exit for profit. If it does not cooperate, okay, we have reduced our losses. So pretty standard. We rolled out our Teladoc short put from March expiration to April expiration. Now let's look at the new trade that we opened. The trade I want to talk about is the rolled trade of a Teladoc. So when I closed the March trade, we had to take temporary loss and I opened a trade for April expiration. Again, it's the same short strike at 115. It's a short put and we got premium when we rolled it out from March to April. Now, considering all the premiums that we have received till date on this ticker, we have a credit of $6.20. Means if Teladoc continue to stay low and keep challenging us, we still have $6.20 of buffer for us before it start to move into a loss zone. I am bullish on this particular ticker because it is related to telemedicine, and as we continue to restrict travel, as we continue to advise people to stay home, even if they have to connect with their doctors, there is a lot more need of telemedicine and the systems that allow you to talk to your doctors remotely. And Teladoc has been in forefront of this. So we'll see how it goes. If I'm able to, if Teladoc goes back up again, we'll exit this trade at a huge profit. If not, I probably will be okay to hold this trade in my portfolio for some more time. Okay. All right. So that completes the section for trade leaderboards. Again, if you have any feedback, be generous in giving me that feedback. The change that happened this week is because of the feedback from viewer like one of you. Okay, now let's get to our next section, which is a new section that I'm adding from this week onwards, is doing a trade analysis. The intent of this section is to make sure that you can understand the thought process, you can understand the mechanics that I go through when I am dealing with some of the trades that have challenged me. So it's from that purpose, I think it was a great feedback saying let's dig deeper into some trade, pick up an actual trade, go through the various stages of the life cycle of that trade, and let's talk about why we did what we did. Okay, or the trade that I am choosing for this week's analysis is a bullish trade that I had done on Mercado Libre, ticker symbol M as Mary, E as egg, L as Larry, and I as India, MELI. So I have been bullish on this ticker, but it's a high price ticker. So when we opened the trade on 11th of February, the stock was trading at $650. It's a high price ticker, so I wanted to go with a defined risk trade. So I went ahead with an iron condor. So generally, iron condor is considered to be a neutral trade, because if you are doing a short put and a short call spread, short put spread and a short call spread in an iron condor, and generally you do it with the short strikes equidistant from where the stock currently is. But I was a bullish, so I skewed my iron condor to make it a bullish trade. So when I opened the trade, the stock was trading at $650. So I took a short put at $610, which is $40 away from the current stock price. And I had my short call at $720, which is $70 away from the current stock price. So I gave myself a lot of room for the stock to run on the upside. And then hence I had skewed this iron condor towards being bullish on the stock. And we had purchased wings at $10 wide. So essentially, if you look at, I had a put spread with 610 short put and $600 long put. That's a $10 wide put spread. And on the upside, I had $720 short call and $730 long call. So this was our opening trade, a bullish iron condor with a width of $10 means the maximum loss that can happen in this particular trade is $10. Lo and behold, I never knew what market's gonna do, and market started to challenge us. We know what happened in the last week of February and has been happening in March. Stock went down. So we started implementing our management techniques. On 6th of March, when stock had fallen down to $617, remember our initial short strike is at $610. and the stock had fallen down to 617 from 650. What we did was to roll down our call from 720 to $700. And when we rolled our call down, we collected additional $2 of premium. So when we initially opened the Iron Condor, our premium was $4.42. When we rolled down the call, because stock had moved down and had started to challenge our short put, so we rolled down our untested side, which is our call. We rolled it down from 720 to 700, collected $2 additional premium. We continued in the same direction because stock continued to move down. And on 11th of March, when the stock was at $563, way below our short put, it had gone even below our long put. So means the trade right now is sitting at maximum loss. So we rolled our call down further from $700 to $660. When we did that, we collected additional $2.55 as a premium. Stock didn't cooperate. It again kept going down. Then on 12th of March, when the stock was $495, I rolled down the call again from $660 to $600. When I rolled down the call again, we collected $2.50 as a premium. So essentially, after we put this initial Iron Condor trade, we have done 3 rolls. First, we rolled down the call from 720 to 700, then to 700 to 660, then from 660 to 600. Every time when we rolled down the call, we kept on collecting additional premium. So here's an actual screenshot from a trading platform. As you can see, the first initial trade, $442 credit. Then we rolled on 720 call, means we closed 720 call, we opened 700 short call, collected $2 as additional premium. Then on 11th of March, we closed 700 call, opened 660 call, collected net of $2.55 as a premium, because we had to pay $45 to close $700 short call, and we got $3 when we opened $660 short call. So net credit was $2.55. Then last adjustment we did was on 12th of March, we rolled down the 660 call, means we closed 660 call, opened 600 call, collected additional $2.50 as a premium. Now if we add up all the premium that we have collected, now if we add up all the credits that we have received, 442 plus 2, add 255 and add 250, total credit that we have received till now is $11.47. And as you would recall, the width of the put spread is $10, because I have $610 short put and $600 put, long put. I haven't touched those strikes yet. So my width of the short put is still $10. And now I have collected $11.47 as a total premium. In fact, I have gone inverted by $10 in here, because my put is at $610 and my short call is at $600. If a stock stays below 600, we will still exit this trade for profit. We will lose completely on the put spread. We will lose $10, but we had collected more than $10 as a total premium. We have collected $11.47 as a total premium. So if stock stays below $600, that's our max loss position on this Iron Condor. We'll still exit this trade at a profit. So what's the catch here? Is there no possibility of losing any money on the trade? No, that's not. The trade-off here is that if stock continues to rise, remember our short call is now at 600. If stock the trade expires with the stock at 610, we will still be profitable because our credit is more than $10. But let's say if the stock expires at 615, then we will lose on the call side. We are losing $15 on the call side option, but we collected $11.47 as a premium. In effect we lose close to $3.50. The trade-off here is that we will lose if a stock goes high. Now, based on what's been happening in the market, I'm okay to lose money if on this trade if the stock is going high, because it means I will gain a lot more in my overall portfolio if market improves. It's okay to lose money on this trade on the upside, because that means the rest of the portfolio is gonna gain a lot more. Also, I hold this ticker in my long portfolio. So I will lose money on this option trade, but I will gain a lot more money on the long stock position that I hold in my long portfolio. So I'm okay to take this trade-off. I'm okay for market to come and challenge me on the upside. Right now, I'm struggling because market is challenging us on the downside, and we feel there is more downside to be had. So it's okay for me that market goes high and start to challenge me on the upside, because even if I lose money on this trade, I will gain a lot more money on overall portfolio, which will benefit if the market goes higher. Okay. So this is how I look at the trades which start to challenge me, and we make some adjustments. I hope this helps you in managing your own trades. This trade will expire next week, so I will continue to keep an eye on this, and if volatility collapses, even if the stock stays below $600 and if volatility collapses, I would try to get out of this trade either at a scratch or at some profit. So we'll talk about this next week on what exactly happened on this trade and how I was able to close it. What's the end result? Okay. All right, let's move on to our next section, which is mailbag segment. And in mailbag segment, I answer questions that I get from my listeners, from viewers, or from those people who email me. So if you want to get your question answered, email me at optiongig@gmail.com, or if you're watching this on YouTube, you can put your question in a comment and I will pick it up and present it for our next week's update. So the question that I want to talk about this week came to me from one of my listeners. The situation is this. That person, he had sold a call when the stock was 50, but now the stock has moved down. Because the whole market has moved down, stock also moved down. So if I sold the call, it should be profitable, but my call option is losing money instead of being profitable. How come? So this is, I think, a situation that would have baffled many new option traders is, hey, my stock, my call option should be profitable, but it is not. And the reason is because of volatility. Like I had mentioned in my last week's update, and I've talked a lot more in detail about it in the podcast episode number 30, is the impact of volatility on option pricing. So while your call option benefited by the stock going down, that benefit was negated by increase in volatility. So stock option prices is determined by volatility, it is determined by the movement in stock, it is determined by interest rates and how many days to expire and a few more factors. most of the time, if volatility stays low or does not change from when you open the trade, you will notice that if a stock goes down, your call option is profitable. But last week was an unusual time. Last week was not a general scenario. Last week we saw volatility exploding. So the decay in the call option price because of the movement of stock in downward direction was negated and lot more by the increase in option pricing because of increase in volatility. So there were two contrasting factors that were impacting the call option price. The downward movement in stock price was pulling the call option price down, but the explosion in volatility was pulling up the call option pricing. And the impact of volatility was higher than the impact of stock going down, and that is why the call option became more expensive even though the stock had moved down. So if you had such position, you would have noticed that instead of call options becoming cheaper, it probably had become more expensive. And it is because it's a volatility that is in play. And many of the newbie option traders, they get stumped by this because only thing new option traders focus is on the stock price. But the professionals and those who are profitable do keep volatility in mind because it can change your positions in a way that you would never expect. And we had seen this in the previous week. So I hope this helps you. If you have any questions, you can write it to me and I will try to answer in our next weekly episode. So this brings us to the end of this week's session. Thank you very much for spending time with me. Stay safe, spend time with your family, and wash your darn hands. All right, everyone. Thank you very much. Happy trading. Goodbye. Please note that all the information presented is purely for educational purposes and is not a financial or investment advice. I don't know you, you don't know me, so do yourself a favor and don't invest or trade solely based on what you hear.